Hi, everyone. Thanks for joining. I see everybody trickling in. You guys all today provide this session just to get a little bit of an understanding, or for some people, a refresher of the P&L. Obviously, it's one of the most important reports and tools for a restaurant leader. And so we wanted to bring Tushar on today to kind of discuss this with you and walk you through it a little bit. So just an agenda, we're going to do some introductions and we're going to talk a little bit about, what are the key KPIs for restaurants? And then we're going to jump right into the P&L review. So we'll be reviewing a bad P&L as well as a good P&L, a restaurant that is more profitable. And then we'll open it up for all of you to ask questions. You can ask any questions that you want to. Doesn't have to be about the P&L. It can be about anything related to restaurants and finance. Please try us. We are an open book. So again, thank you so much for taking the time today to join us. If you have any questions during the session, we'd prefer if you keep them to the end. But if it's like a burning question or you can't see something or you can't hear us, please just message us in the chat and we'll get to you. All right, and without further ado, I'd like to introduce my colleague Tushar. Tushar, please take it away.
Morning, everyone. I think we've got a real mixed bag in terms of sort of skill set. We've got some people that are within the finance function and other people that are sort of more operational in terms of the hospitality industry. I just wanted to introduce myself. I'm Tushar. I've got over 20 years experience working in finance, qualified accountant and a qualified treasurer. I've worked in numerous jurisdictions, Europe, Middle East, and the US. And I've joined Paperchase about 3 years ago, mainly managing a portfolio and advising hospitality clients, liaising with investors and owners, and really trying to sort of make the financials and what we produce for our clients more understandable and to allow them to sort of aid operations and become more efficient, especially post-COVID and post-Brexit in the UK. A lot of pressure on restaurants in the UK. Why do you need financial skills? I mean, one of the areas, if you want to grow and become a general manager and move up the chain within a hospitality industry, is that you need to really understand the financials and what are driving the results of your business. So financials are one thing that you really need to sort of understand. As I said, we've got a mixed bag of participants. Unfortunately, for some, this might be a bit simplistic, but others, it may be sort of a new ground to sort of go over. Couple of key KPIs that relate to sort of financial reporting when it comes to the hospitality industry. One of them is obviously average spend, because that actually drives your revenue. You then got to control your cost side of things. And the two biggest costs essentially are your food and beverage purchases and also labor. And your labor, obviously, in this current climate, with lots of pressure on staff shortages and also with rising costs related to payroll in terms of minimum wages being increased every year. So one of the most important sort of financial sort of reports is the P&L. And as Caroline said, we will run through examples of P&L. So profit and loss, it's an income statement. It basically records all the sales or revenue that you've made, less all the costs that you've incurred in order to sort of produce your product. In this case, obviously in hospitality, to provide your food and your beverages. And also it then takes off your labor and your operating expenses, which are things like your rent and your electricity and sort of operating like cleaning and linen and that sort of thing. That all comes down to a profitability number of EBITDA, which is earnings before interest, tax, depreciation, and amortization. That's probably the key metric that most operators should look at, because if you're on the ground in a restaurant or hospitality industry, there's not much you can do to actually control what comes below EBITDA. The tax is the tax. The depreciation is, set once you've spent money on acquiring and building your restaurant or establishment, and once you've taken a loan out, the interest is pretty much fixed. So I would say that EBITDA is a key number to focus on to make sure that you're actually profitable. And at the very bottom of the EBITDA of the P&L comes net income, which basically takes off interest, tax, depreciation, and so on. As I said, a couple of key profitability sort of metrics that you should sort of follow in the hospitality industry. One being gross profit, which is your revenue minus the cost of producing your food and beverage. Quite a key sort of metric. And what we'll do when we look at the two examples that we have is that we'll give you sort of a target range for what that should be. Just so you can sort of understand what you should be roughly seeing and what you should be managing to. As I said before in the previous slide, EBITDA is the key focus, which is sort of your revenue minus your cost of producing your food and beverage, less all your operational types of expenses. And then, as I said before, the very bottom, net profit. So let's dive in and look at a couple of examples now. So hopefully everybody can see this. We've got here a profit and loss report for a quarter, which is a business that isn't doing particularly well. So let's dive in. What do we have at the top? So this is a quarter. The first thing to notice is that you've got 4, 4, 5 at the very top here. We have a real mixed bag in terms of our client base who actually report on a 13-week quarter versus some businesses like to see monthly. There's no right or wrong in relation to that. Normally, we prepare a weekly P&L and the weekly report and the sales numbers. Those weekly reports are directly comparable to this 13-week period. And also, for 5 basis, it's much easier to sort of budget and compare to budgets on a 13-week and weekly basis, essentially. Other clients dispense with that and just focus on each individual month. So comparing January 2024 versus January 2025. So there's a real mixed bag. There's no right or wrong answer. At the very top of the P&L, we've got the sales, which is essentially, your covers, the people coming into the establishment times the spend. We split it between food, drink, beverages, and other. You'll notice on this basis that the food and drink are pretty much split 70-30. This is sort of roughly sort of what happens in most establishments. Obviously, if you're a bar and you're serving food, not as part of your main offering, your beverage side of things will be a lot higher in terms of percentages. You'll notice here that January is relatively low at 47,100. and then the revenue starts to build. January historically in hospitality is a pretty slow month. Obviously February, you pick up on Valentine's trade, and also on March normally incorporates Easter. As we scroll down, you come to gross profit, which is, as I said before, one of the key measures of financial health. It essentially shows, as I said before, your selling price or sales by category, less the cost of producing your food or beverage. And it's profit. The number here, 31,100, is your profit prior to covering all your other expenses. If we now look how this is sort of constructed, so how do you go from 47,100 to 31,100? So over to the side here, we've got what is called your cost of sales. Your cost of sales are essentially your opening stock, add your purchases, less what you have not used or consumed during the course of the month. That comes to your cost of sales. So in this example, it's 13,000. So 47,100 minus your 13,000 gets you to the 21 number. So sorry, this example is just based on the food cost of sales. Your cost of sales is 38% in this example. Your gross profit on that basis is 62%. So your gross profit plus your cost of sales in percentage terms will always come back to 100. So you can see here the total is steadily increasing. But what's also more important is looking at the cost of sales percentage. And I'll go into what people target in terms of cost of sales, gross profit, when we look at a good P&L, and just give you some key metrics around what that looks like. But you will notice to the side, we've also got something that I wanted to highlight. It doesn't matter essentially what your purchases are. So if you look in this example, this column here, we've created the same gross profit, but your purchases in this sort of column are 100,000. As long as majority of that falls back into closing stock, your GP can still be 62%. Where this will affect is the following month, where this closing stock will become your opening stock for the new month. And then depending on your purchases on your closing stock, your GP gross profit margin will probably be affected and be a lot lower than what this 62% is. I just wanted to make sure that was highlighted. So, purchases are sort of irrelevant to some extent if everything falls into closing stock. I think your main focus when managing a P&L and managing costs should be on your gross profit and your wage costs for an operator. These are the two biggest impacts that you can have as an operator. So managing the purchases and the food cost and beverage cost, and also managing your rostering and your profitability. That will impact your profitability more so than sort of shaving £100 here and there off of expenses. Not to say that expenses aren't important to focus on, but the bigger impact is at the top end of this, where you've got your cost of sales, managing that, and also your wages. And most of the costs further down, you can't really influence. So, for example, rent expense, there's not much you can actually do once the rent and the lease is actually signed. It's a regular amount per month, essentially. So we look at the wages side. The wages side, extremely important to manage the rostering, which everyone probably does, if you're an operator. You don't want to have staff being paid and are not really generating any revenue. You need to cover their wages, so they need to generate revenue in order to cover their wage costs. The way Paperchase prepares P&Ls, we normally split between the various categories: front of house, back of house, kitchen porters. This will help you identify any anomalies and also see what the trend is. So if you look along this front of house line here, you can see in January 8,000 in terms of cost, rising to 11, and then in March the 18,000 is for a 5-week period, so hence the increase in cost. But that is all should be in line with your sales. So you can see that it starts off at 17%. Sorry, and these percentages against sales is the sort of sales are your driver for some of these costs, essentially, and managing them to be in line or pretty stable with your sales number. So you've got 17% falling to 13 and then bumping back up to 18 in terms of just this example. In this P&L, the January wage costs look extremely high. So your measure of gross profit in this P&L for January, what you made after you took into account your cost of producing your food and beverage, you're left with 31,100 in terms of gross profit. But you can see immediately that if your staff cost is 39,700, your gross profit is wiped out and you're not going to make a profit during this month. You'll be in a loss-making position. But if you look at February, you've got 56,000 in gross profit, and your wage cost is 44,000. So there is some profit left after taking into account your staff costs to cover the rest of the expenses. You can see that the percentages are very high: 84%, 52%, 59%. And when we look at a good P&L, I will give you some sort of metrics that will allow you to sort of try and understand, by just looking at gross profit and staff costs, whether you're going to make a profit, even if you don't scroll down to the bottom of the P&L, just by sort of focusing on gross profit and cost of sales and staff costs. As I said previously, while the bigger impact is on the GP and the wages side, you shouldn't totally ignore the expense side, because every little helps in terms of managing things. But as I said before, the bigger impact is on your GP and wage line. Those two are managed to certain metrics, then you will end up with sufficient profit, hopefully, in order to cover the rest of the expenses. Out of all the expenses, so the way that Paperchase divides up the P&L, we put everything into categories. So the first category is operating costs, and this is the one that most operators can actually influence to, in terms of managing, and they're all directly related to providing the service. So things like linen, cleaning, kitchen accessories, restaurant accessories, so on. Maintenance and so on. Again, in this January P&L, it looks extremely high, 8,800, and that's mainly because of a sort of one-off maintenance repair bill that's showing in this profit and loss, and also some sort of one-off in terms of a high telephone bill for something or other. Plus, the reason the percentage is high also is your sales are not at the same level as they are in January and February, and you're comparing the 8,800 versus your sales number, and working out this percentage based on that. What comes next in the P&L? The way that we do it is we put through promotional and marketing type costs. The key metric around marketing, promotions, advertising is how do you actually track that your advertising or marketing campaign is actually making a difference and adding sales. That's the real difficulty in trying to identify that in practice. Most people use specific marketing links to get people to book through those links so they can track sales and so on. But it's quite difficult to track that in the real world if you've got sort of not some sort of link that people have to be directed to sort of book through. The other thing that can be controlled to some extent is complementary items. Complementary items are normally because of sort of some sort of error or bad service where you're providing the customer with some complimentary food or a reduction in the bill or some sort of discount. Again, the way we run our reports, we track that by reason. So you understand whether you're getting repeated errors coming through operationally. And also we track it by employee, just to see if the employee has any training needs going forward. If there's a repeated sort of complimentaries being booked against one employee, maybe they're not quite with the program and need some further training in terms of sort of ensuring they understand how they should be doing things. Obviously, the goal on the complementary side is to try and have smooth and efficient operations. So you minimize the cost and you have happy customers essentially. The next section is very difficult potentially to sort of influence if you're an operator. As I said before, probably the two things that can be influenced are the energy and the water cost. All the other costs are sort of relatively fixed, I'd say, or semi-fixed, if you want to call it that. Obviously, as I said before, if you're signed up to a lease, the lease will be, fixed, and your rent will be fixed per month, unless you have an element of sort of turnover rent. But it's relatively fixed. The service charge, whatever the landlord charges, business rates are pretty much fixed in terms of being set by the government. And then you've got repairs. The repairs here are different to the repairs that are higher up. This is more of operationally the equipment and repairs for those items, whereas lower down in our P&Ls, this is more about building repairs or infrastructure sort of repairs. Again, in this P&L, because the sales are low, the overall sort of cost looks relatively high in January. The last section can only be reduced by negotiating with various parties. Normally, your credit card provider, your merchant provider, you agree fees with them, and it's sort of a fixed percentage. Insurance, you'll obviously agree to whatever the premium is once a year, and it's pretty much fixed. Professional fees, legal and that sort of thing. You may have a security contract in place, again, pretty much negotiated up front. And then you've got sort of audit and bookkeeping fees that come through in this section. So you then finally get to a metric called EBITDA, which we talked about previously, which is earnings before interest, tax, and depreciation. And as I highlighted before, just focusing on January, just by looking up here and seeing that your gross profit was 31,000, less what your staff cost was, which close to 40,000, you're already in a loss position at this level in the P&L without taking off all your other expenses. So when you're further up here, you know immediately that you're going to have a loss once you take off all the expenses that you've incurred during the month. And that's what's happened in this P&L. You've ended up with £42,000 of loss, and the other months are pretty similar. And then looking below EBITDA, this is where I'm saying that operators don't have much ability to sort of influence anything that's below EBITDA. Again, once you've taken out a loan, the interest on that loan is sort of pretty much fixed. So unless you're in a position to negotiate and agree to sort of any financing terms, it's hard to influence this number and try and make yourself more operationally sort of efficient and reduce the cost, essentially. Depreciation, amortization. Depreciation is sort of an accounting concept used to spread the cost of acquiring tangible physical assets. So if you go out and buy tables and chairs for the restaurant, those costs are recorded on your balance sheet and are written off over the life of the useful life of that asset. So if the table and chairs last 5 years, for example, they will be written off and recorded over that 5-year period, and that's what this monthly cost is. Amortization, slightly different. Amortization is essentially sort of the writing off of intangible assets. So things like licenses, trademarks, that sort of thing. You then come to potentially a dividend distribution to shareholders, and also the corporation tax, which is tax on your profits and set by the government. So there's not a lot that a operator can actually influence lower down in the P&L, but that then gets you all to net profit. That's why I was saying that you should focus on the EBITDA line, because quite a lot of the items in there are controllable to some extent. And obviously the gross profit is the one, gross profit and the wages are where you need to focus your main attention. Just looking at January and this P&L, it's basically the negative result or loss has basically arisen due to the low sales, relatively low gross profit margin. So your sales 47,000. Your gross profit was 66% of that 47. You've got obviously high wages in this scenario, and your costs are relatively high compared to the actual sales. If you look at the costs, they're 156% of your sales. And there was not much scope to reduce costs during the month for this fictitious sort of P&L, and majority of the costs were pretty much fixed. Difficult month on that. So now let's look at a better P&L and give you some key metrics for you to be able to sort of manage your P&L and turn your business around and make it more profitable. So hopefully you can see this. It is what we've termed good P&L. So looking at the top, much more robust numbers in terms of sales. You're looking at in and around the region of £500,000. Again, 445, but in a slightly different order. 454, but this revolves around when this company has its year end. If you look, the sales are roughly again 70/30 in terms of food and beverage, in terms of split. Scrolling down, you've got gross profit. Your gross profit, you'll notice, is all above 70. So what should be the target for your gross profit? Most hospitality businesses are sort of in the region of 70 to 75% of sales for gross profits. So that would imply that your cost of sales should be in the region of 25 to 30% in order to hit a gross profit of 75 or 70 to 75%. That should allow you enough profit to cover your expenses and hopefully make a net profit. In later webinars, we're going to run a series of sort of webinars, and we're going to look at sort of controlling your GP and what strategies there are for management to actually control and sort of ensure that your GP is in that 70 to 75% range. So I won't delve too much into this at this moment in time. On the wage side, again, if you remember the bad P&L, the target was a lot higher. Well, not the target. The result was a lot higher, between sort of 100+% and also 80-odd%. Here, you've got wages coming in at around about what, 28, 27% of sales, which is extremely good for a business. We would normally say that your wages should be in the region of 30 to 35%. Obviously, there's been a lot of pressure on wage costs over the last few years with labour, as a result of Brexit, and also sort of regular increases to the minimum wage. All that's put pressure on wage costs. So anything in sort of the 30 to 35% bracket is actually pretty good. Earlier I said, how do you actually know that you're going to make money by focusing just on your cost of sales or your gross profit and your wage cost? If you look at the percentages here, your cost of sales, which is obviously the cost of producing your food and beverage, here you've got 24%, 27%, 26%. If you add that to your wage cost, you've got 28, 27, 28. The combined is coming out to around about 50 to 54%. If you're in the sort of in that bracket, the 50 to 60% of your combined cost of sales and your staff costs, then you should have sufficient profit left after focusing on cost of sales and staff costs to actually cover the rest of your cost and also make a EBITDA profit and also a net profit if you don't have any one-off large costs or anything. So here you can see again on the cost side, operating cost side, metric wise, what should we be targeting? I mean, you can see here that everything measured against sales, because sales is driving your P&L to some extent, and you're trying to sort of ensure that your costs are pretty much in line with sales at a certain set percentage. So what we tend to sort of advise clients that what we should be seeing here is between 8 and 12%. Obviously, increased costs are filtering in under all contracts and services and higher prices for various things. But a general rule of thumb, 8 to 12% of sales would probably be a good metric for your operating costs. That's what we see with most of our clients in that sort of bracket for a sort of a well-run and well-managed P&L. On the marketing sort of front of things, again, because the sales are so high, these percentages are all under 1%, but anywhere up to 2% is a good sort of metric for the sort of marketing and promotional side of things. And scrolling down further, we've got your property section. And as you remember, I said quite a lot of this is for an operator is quite hard to actually control because things are set once they're negotiated and run for a period of time. And obviously, there's a climate of higher sort of inflation and pressure coming from cost increases for things like repairs and renewals and sort of energy costs. I mean, one big impact that will happen next year is on rates bills. Hospitality clients at the moment have quite a substantial discount that the government have provided or support post-COVID of 75% of business rates, being discounted by. But next year, April, that looks like it could reverse unless the government keeps some sort of support going, and that will have a big impact on most people's P&Ls for next year. And then scrolling further down, we have again the finance cost, and we would normally target around 2 to 3% of sales costs appearing in this sort of bracket. Again, looking at the result for this P&L, we've got a profit across the board, which is pretty commendable given the cost. And you've got to think about it in this perspective, I think, is that, in the UK, current bank interest rates, if you put your money and didn't invest it in a business, you would probably get in the region of around about 5% in terms of return by putting your cash on deposit with a bank. The return here is around about 20% of sales that you've made. In excess of 20%, I should say. Even at the net profit level, it's in excess of 20%. So it looks like in practice, this is a really good deal. But one thing that you've got to really think about is that when you're putting money on deposit with the bank obviously is sort of viewed as a low risk, whereas this return of 20% takes into account the risk of investing in a business. So these margins are excellent, but you've got to view it that 20% plus is taking into account the actual risk of investing in a business. But having said that, with the right concept, businesses are hospitality businesses can be very profitable, very rewarding, and people always need to eat. So there'll always be people spending money in the hospitality sector. You've just got to hit the right concept and manage your P&L accordingly. So that's all I wanted to say and go through. We're sort of, I'll introduce my colleague, Perrin, who's going to join for the Q&A session. So hopefully we've got lots of questions, and please feel free to sort of ask away.
Awesome. And we also have Nish on the line as well. So everybody can just go ahead and drop your questions, any questions, into the chat, and we'll go ahead and get to them. Ahmed asked, can we get these examples somehow? Yes, definitely, Ahmed. We will send them to you after this session. We'll be sending everybody the files for both examples that we gave. Any other questions from the audience? It can be literally about anything. So Sanjay asks, is the good P&L an actual business or fiction? It's fiction. So we have, mimicked what we've seen in other restaurants that are having good profitability, but all of the figures are fictional.
And I sort of, when I pulled the example together, I wanted to do the two extremes. So something that is sort of really negative and then something that is really positive, sort of thing.
Ahmed asks, should wage percentage be within a certain range or do all businesses differ? Great question.
What we tend to sort of advise clients is that or what we see from all the hospitality businesses that we look after, that the wage percentage is sort of in the region of 30 to 35% of sales. If you stick within that sort of metric, you're managing your rostering according to the busy periods. So if, for example, let's take Christmas. Christmas is a great example, or to sort of give you guys. Christmas and year end obviously gets a lot busier, lots of events in hospitality, lots of activity, Christmas parties and that sort of thing, and people going out essentially because of the holidays. So you're a lot busier, but you're going to need a lot more staff in order to cope with whatever is coming through the door. So your wage cost will go up, but also your sales should go up. So the percentage should be roughly the same, if you're managing your staff costs. And that's what we're saying in terms of rostering. So your rostering should follow where the expectation is for busy periods. And the other way that Paperchase sort of looks at that is that we do, as I said before, we do provide a weekly report, which some wage costs, and you can see week to week what your wage costs versus your sales are, and you don't have to wait a complete entire month for a P&L to be produced for the month. You can sort of manage it in more detail week to week.
And Tushar, do you want to just repeat for the audience, like the ideal wage percentage that we like to see for like fine dining and casual contemporary restaurants in the UK?
Yeah, I mean, what we've seen from the rest of our clients is sort of in the range of 30 to 35%. Obviously, in the good P&L example, it was lower than 30%, but that was just me making up numbers, that sort of thing. So, it's a real mix of what we see. Obviously, for new startups, the percentage is going to be a lot higher. But, if you're targeting the 30 to 35% and you can keep your cost of sales, in the region of, 25 to 30%, those two added together should allow enough profit, to allow enough profit to cover your expenses, and you'll make money essentially. And that's what it's all about, right? For you guys, making money.
Awesome. Thank you so much, Ahmed, for the question. We'll go to Khaled's question now. He asked, you mentioned premises cost at 6%. Isn't it quite low, or does it vary from country to country?
I think I just made up the numbers, right? And the reason it was probably 6%. Did I say 6%? Oh no, it's showing 6%. The premise cost overall, I think we're targeting on the premise side. Sorry. What did I? Yeah, we're sort of saying between 8 and 12%. And it sort of, I'm assuming, Kelly, you're based in the Middle East, and property lease values are probably a bit higher. At the moment in the UK, with there's a lot of surplus premises that come into market. So if you get a good deal, it is obviously a lower in terms of percentage. But I think it would vary country to country. And I'm assuming that Middle East would be a lot higher than what we would see in the UK potentially.
Great. We'll go to Sanjay next. He asks, currently in the UK, what proportion of businesses are in the good P&L camp, especially those with a much smaller turnover?
Yeah, great question. I think at the moment we are sort of in this transitional phase. We have some clients that are doing very, very well, and some clients are sort of everybody's worried about cash flow, essentially. And I think what's actually happened is because inflation over the last couple of years has been relatively high, and people have been struggling with, all sorts of costs, energy costs, and sort of every cost has virtually gone up. I think there's been more in terms of the bad side of things, where people have been sort of struggling their way through. But if the concept is good, people are still making money. I think also what's happened is that people have different income brackets, and this is my personal belief. So I think the higher end, if you're an average person off the street, you've either save up and go out less, but you hit a higher priced establishment, or you trade down and you sort of still go out a couple of times a week or month or whatever it is, but you trade down to the lower sort of average spend. So it's sort of a bit of a mixed bag, I think, at the moment. I would probably say that we're still in a bit of a transitional phase, and I think the next few months will see people hopefully, with inflation coming down, really move into the good P&L side of things, and things take off. The other thing that we're actually seeing is we've got quite a bit of activity on new concepts and new restaurants opening in the UK market. So people still have the confidence that the market will turn in hospitality. Well, not turn, but improve. Let's say improve. So there are things opening all the time, and projects coming to market.
Awesome. Luigi asks, can you explain amortization again, please?
Yeah, sure. It's similar to depreciation. So it's essentially an intangible asset that you have on your balance sheet, and it's essentially written off over the useful life of that intangible asset. Something like some sort of license fee is probably the best example. So if you have a license or trademark that you have on a certain something or other, then if you believe that that has 5 years before somebody else sort of clones the concept, then you can sort of to record that and the costs related to that, and write it off over a period of time. What it actually means is you don't take the full hit in the P&L in one period. It's sort of slowly spread over the useful life of whatever that item is. It's a very technical sort of accounting term, but I was trying to sort of boil it down into sort of simple concept.
Ahmed Al Momen asks, and I believe that he's referring to labor cost percentage, but Ahmed, please correct me if I'm wrong. He says, what if your concept isn't just food and beverage and there are other revenue streams such as event tickets? Is it the same theory?
Sorry,
I'm
sorry.
guessing that's in
The
relation
other revenue
to.
streams, F and
Sure, I can repeat the question. What if your concept isn't just food and beverage and there are other revenue streams such as event tickets? Is it the same theory? And he's asking, I believe, about wage cost percentage being in that same range.
yeah, I mean it's interesting because again, it depends. Christmas is a very good example, right? So if you're doing lots and lots of events, if you can gear up, well, sorry, no, if you don't gear up on your staff and you use the existing staff to cover those events, then obviously you're generating revenue, but you're not adding any wage cost. So your overall percentage will go down. It comes to an operational sort of side of things where, can you cope with what is going to be the sales uptick for events and not gear up on staff? That is the ideal scenario, right? You
Yeah.
use your existing staff and sort of your wage
No,
percentage
so
is relatively low.
Tushar, sorry to cut you off, but I think the question is a little different. So let me answer that question. Uh, yeah, so Emma, there are different concepts. So we actually had a client in New York called Museum of Ice Cream, which is non-F&B client, and their business is based on ticket sales, right? So they open this pop-up museum just for 2 months or so, and then they sell the tickets. And in those, the metrics are totally different. Your wage cost would be probably less than 15%. Your rent cost will be high. Your production cost will be high. You have maybe 10% of your total revenue towards F&B. So it will be altogether a different metrics. So each business will have its own F&B percentage driven on their P&L. So I think one of the question earlier was also like, what should be the wage cost, right? So QSR, which is a fast casual and quick service restaurant, will have a lower wage cost, but they will have a higher premise cost because of how the business operates, and they will have lower food costs compared to fine dining or semi-casual restaurant. So every business will be different, but for non-F&B ticket-based revenue, where it is an experience, we have another client where all they do is like an immersive art, which is on LED and etc. It's called Moment Factory. So every business will have a slightly different P&L metrics. So this will not be a guiding principle for each and every businesses in general. Sorry, Tushar, to cut you off, but the question was a little different. I think you had little internet issues, so you could not hear it well.
Right. Okay. Yeah, and I think, like Nish said, that these sort of metrics that we're sort of putting out there are just broad brush metrics, right? I think Nish is right. It depends on your specific restaurant, but sort of overall, you should be in some of these bands in order to make a net profit.
We've got two similar questions from Nisha and Marco. They're asking if benchmark percentage can also be made available and if we can have a detailed breakdown of the optimal percentage distribution for all profits and costs. We can definitely send that to you after the webinar. And if there's like any specific things that you're curious about, any specific benchmarks that you're looking for, just feel free to email me. I've dropped my email in the chat, and I can give you something more detailed to what you're looking for. Simran asks, in both examples you showed us, is the wage cost measured against gross restaurant sales or net sales?
Net sales. The sales recorded here are with excluding VAT essentially, because your VAT effectively sort of is held on the balance sheet until you need to pay it quarterly. So these are all net sales.
Awesome. Any other questions? We have about 5 minutes until we wrap up. I'd love to get a couple last lingering ones in here. Truly, anything you want to ask, whether it's complicated or very simple, we'll be happy to answer. And yeah, after this, everybody will be receiving a recording of the session, and we'll also send the examples that we went over today. Someone in an audience asks, from your experience, what is a typical ask from investor loan in terms of timeline, and how does that affect the P&L in the short term? Great question.
So I assume you mean in terms of investor timeline in terms of repayment?
I'll repeat one more time. A typical ask from investor loan. Yes, I'm guessing repayment in terms of the timeline, and how does that affect the P&L in the short term?
It wouldn't affect your P&L unless the loan had interest on it, right? So any repayment for your investor, if it was a loan. But if we're talking about dividend return, I mean, it's difficult to say. I mean, a 5-year timeline, maybe what people should look at. It depends also if it's a new business and from scratch, or the concept is already there. Obviously, for a newer business, it might take longer to get established, a new concept or something. So it may take longer than the 5 years, but I think a general rule of thumb in terms of sort of potential return should be in that 5 year plus bracket, essentially.
Yeah, so typically loans are get paid within depending on the investor, but generally 3 year would be a good number if you have to pay back the interest. uh, and the way the loans can be structured is like, do you have to pay interest now or you can pay it end of the year, so it affects the P&L accordingly. Generally it's not part of EBITDA, which Tushar mentioned, the EBITDA. So interest expense will fall after EBITDA, but it will definitely hurt your cash significantly if interest rates are high.
And I think it also depends on, I think the question is more about investing. So, you could put in loans to a business, but also you can buy into the business in terms of equity. So depending on what is actually provided, it will have a slightly different impact. Because
Awesome.
your return on a loan will be the repayment plus the interest, whereas under the equity side of things, you're actually receiving dividends and taking more of a risk on the business because you've got equity. Whereas loans, potentially you could have them secured on some sort of asset, so there's less of a risk. So the return, essentially, people normally look for a higher equity return than they would for a loan being provided. And it's just the level of the different level of risk that you're taking on, the equity versus debt.
Awesome. If there are no further questions, we'll start wrapping up. Thank you guys so much for joining us today for Restaurant Finance 101. As Tushar mentioned, this is the first of many sessions. If there are any topics that you want us to cover in further sessions, please let us know. I've dropped my email in the chat. If you have any questions afterwards, any comments, any feedback, we really are open to learning and want to hear from you. So please email us. As I mentioned, I'll go ahead and send out the recording to everybody. And if there are any, please feel free to share it with your team members and also your friends and colleagues outside of your own business. Definitely want to spread the word and educate more and more people, as many as possible. If you have any friends or colleagues that need Paperchase's services, we do accounting and finance service for restaurants and hospitality businesses, and we'd be happy to help out any friends of yours. So thank you again, and thank you to our host, Tushar, for joining us today. We look forward to seeing you for the next session.
Thanks, everyone.
Thank you, everyone. Thanks for joining. Thanks, Caroline.